Good morning, everyone. Thomas Montgomery with Smart Money Alliance and IIMFL. It's our pleasure to visit with you on most weekdays, Mondays through Fridays, at this time at 8 o'clock Central. We're about a minute before. We'll hop on this Zoom and talk about what's new and problem solve and share information with our distribution partners. We have different types of distribution partners, so let me recap that briefly and then we'll dig in. So we have affiliates. Our affiliate program is great, right? It's free and easy to become an affiliate. You don't have to buy anything, you don't sell anything. And affiliates make on average $2,000 for just submitting a name in to the landing page that we give them. Now, that again is triggered off of conversions. In other words, that lead that they put in ends up enrolling in the Capital Ready program or the Access to Capital program. And they go through the process, of course. So affiliates, everybody should be an affiliate because it's free and it's easy and it's lucrative. Then we also have our financial literacy educators. Financial literacy educators should also be affiliates, but not all affiliates are financial literacy educators. Financial literacy educators actually work with the clients through the 4-week initial process, which we're not going to go into too much detail today. You probably already are familiar with it, but that's where we're improving financial literacy and building their loan package. So financial literacy educators are paid more because they do more, and they're also writing the key person policies. Because of that, they need to have a life insurance license. If they don't, then we can help them get one and we reimburse the cost of that. Or if they're already licensed, then we just get them set up properly. So that's the second role, right? We talk about the affiliate, and then we talk about the financial literacy educator. The third role that you're going to hear us talk more about is the joint venture role. We tested that, we had good response, and so we're going to move forward with rolling that out on a broader basis. Joint venture partners we'll talk about more at the end of this conversation. It's even at the bottom of this email. So we'll talk more about the benefits of being a joint venture partner. Now, with that said, though, our primary topic today is that of great news. So as everyone's aware, you're aware, I'm aware, everyone's aware, our nation, and what's more important to you and I, our financial model in our nation has been impacted by this pandemic. So we started out the year 2020, and the markets were open, access to capital was flowing, credit was available. And then the pandemic hit, not to suggest that it has ended, but it hit in a lot of uncertainty. So banks started to tighten up and started to set aside millions and billions of dollars for the expected defaults. People started to be able to defer their student loans, their home loans, their auto loans, their credit cards. And so all of a sudden the market became very unsettled, very uncertain of what was going to happen. Well, I'm not here to say that everything is crystal clear, but what I can tell you is that the market is now, really just as of now, this month in October 2020, returning to more normalcy. And what I mean by that specifically is we see new sources of capital starting to become available, which we'll talk about one in a moment. And also some of the sources of capital that either had closed or had become very, very restrictive are opening back up. Now, throughout the past 6 months, 9 months, we've been able to continue to do client funding. SBA loans have continued to fund, but everything has moved a lot slower. And so I'm not here to suggest that everything is back to normal. It's at a new normal, and we're going to talk a little bit about that. But what's great is that access to capital is much more accessible. So now we're able to move clients into funding more quickly and more consistently. So let's talk about a couple of the highlights that you see here on the screen. We had a committee meeting yesterday, and we just rolled out a new source of capital. Now, what you always want to remember is that there's many different sources of capital, and each have their own underwriting criteria. And in fact, there's 3 main strategies to raise capital to grow a business. Debt-based, money that we borrow that we agree to pay back, and it can come in a lot of different forms. Equity-based, which is money we don't have to pay back. It's investor income. And then earned income, which is always smart, and that's where our opportunity fund fits in. Separate from that, though, let's talk specifically about a new source of funding just rolled out yesterday that is for startup businesses. Because what you often hear about is, sure, if you got a really successful business that's been around for a bunch of years and you have great personal credit, oh yeah, you can go get a loan. But that's not where most of the marketplace is. And as you know, I think, certainly the case, we work a lot with pre-launch and early stage businesses. And so we need to be able to provide access to capital that does not require quite the complexity or maturity that's typically needed if you just went to your bank for a loan. So this new source of capital is available for startup businesses. Now, it's often just the first tranche. So you hear us talk about tranches. Tranches means rounds of capital. Of course, we want to do the least amount of work and the least amount of time to get the clients the funding that they want. But in some cases, clients are going to have to stair step to get there, to build their credibility. I was talking to a client yesterday. She went from wanting $100,000 to she wants $1 million. She wants $1 million. Well, that's fine. If $1 million capital raise is what she wants, that's what we're going to work on, and that's what we'll do. But that doesn't mean just by her changing her mind and say, now, oh, I want $1 million, that, oh, well, great, you meet all the credibility factors. Let's get you $1 million first. We're going to have to work towards that. So this is just one tranche, often an early tranche. Typically, it'll be the first tranche going forward, a business credit card with no personal guarantee. These didn't really exist over the past couple months. You can get business credit cards with personal guarantees. This is one without a personal guarantee. Now, to be honest with you, that doesn't mean that they don't look at personal credit on this credit card. They do, but the minimum credit score is very low. It only requires a 300 FICO. So the approval rate has shown to be 91% as we've tested this. So this is good. So will everyone get approved? No. Will most people? Yes. Do startups qualify? Yes. Can you have horrendous personal credit and qualify? Yes. Will everyone get 10,000? No. It's up to 10,000. Again, what you and I have to avoid is getting caught in too good to be true. You know, the more credible someone is, the more access to capital that they have. A lot of times, you and I are going to be working with folks that aren't quite that credible yet. We're working on that journey, but we need to get some funding in the short term. So this is great. So don't be confused. Don't start asking, oh, okay, well, I need to just start referring people in for this. No, we build the loan package over a 4-week process. We educate them, we gather information about their credibility factors, and then our funding committee will make recommendations of the right sources of funding based upon their circumstance. So there's nothing different that you need to do. There's nothing that's changing because I'm just giving you some good news about new sources of capital that didn't even exist before. Instead, it's just simply submitting people into your landing page. We'll take it from there. If it's someone you've already submitted, this will be one of the available sources of capital for them if they qualify. Okay, so that's good news. That's number one. What has changed is, let's go back to business credit cards for a second, which is the prior point. So early this year, getting business credit cards readily available. We're getting clients $50,000, $75,000, $100,000 of business credit cards under their EIN, reporting under Dun & Bradstreet, building their business credit profile, all happy and wonderful, often with initial 0% or very low interest rates. That's not meant to be that's their only source of capital, but that often was an early source of capital that could provide some liquidity and working capital if needed for the later tranches. But during the pandemic, things really tightened up. Chase, Wells Fargo, Bank of America almost completely stopped issuing credit cards. Why? Because they just weren't sure of who was going to be able to pay back debts because of all those deferments and the issues that I mentioned earlier in this webinar. But now it's starting to open up, but it's not the same as it was before. So specifically what's happening is that when we apply for business credit cards, just for example, it is not unusual for a decline to occur because they're still managing credit tightly. However, what we have seen, what we're able to consistently do is contact the underwriter because of existing relationships we have with them and be able to get a manual review and an override and approval. So it's a little bit more of a painful process, more on our part than on the clients, but that is working now. Now, some cases we've got to call and we may be on hold for hours to get to the underwriter. So I'm not suggesting that it's back to normal, but this is probably the new normal. So can we get some sources of capital now that we couldn't in the past few months? Yes. Is it requiring more effort? Yes, and that's okay. That's what we're paid for. So this is a big deal. And building business credit is crucial. Now what we're doing for all of our clients is encouraging them to work with us to build out their business credit profile. We have a young lady in our office, ex-Army vet. Her full-time job is working with clients to help them build their business credit profile and start building that out so we can access capital under their EIN. So that's an important part of the capital raise process. It's an important part of strengthening the credibility of the applicant. And now we're starting to see a return to normalcy in terms of being able to access capital under the EIN, which is awesome. Also, we kicked off a bridge loan program a little bit less than a year ago, and it's through a private equity group. And it started really nicely. And it was set up where we were able to get a loan for our clients to pay down their credit card utilization. Because what you know, and I know, is if you have high personal credit card utilization, it does a couple things. It lowers your credit score, just temporarily, but it lowers your credit score. It makes you look distressed. And then third, it greatly limits your access to capital for those two reasons and others. So we launched the bridge loan program about a year ago and had some success with it. So essentially what we would do is we would wire the client money, $5,000, $10,000, $15,000, whatever is needed to pay down or pay off their credit cards. I mean, it's the real deal. Now, it was a very short bridge loan though, right? So what was meant is, okay, let's pay off your credit cards, scores will pump up, then we'll go to funding, whatever funding that you were eligible for, but the barrier was your high credit card utilization, and then you pay back the bridge loan right afterwards. Well, those never stopped over the past 6 or 9 months, but to no surprise, that private equity lender got a little bit more conservative too, right? Because of worries, is the person going to be able to actually pay them back? That's back up to full steam ahead now, and that is working out really well. Keep in mind, we charge the client for all sources of capital raised. Well, that's important to understand, but it's also important to assimilate on your part. You're paid off of that. So let's say that you're one of our joint venture partners, which I'll get to in just a moment. And so we help the client get we'll just use even number, $10,000 bridge loan to pay down their credit cards. Well, you're going to be paid 3 to 5% as a joint venture partner, even off of that. So you're going to make $300 to $500 off of that, let alone any additional capital raises. So we're very non-discriminatory. We're very consistent. Any and all sources of capital that we help the client access, regardless if it's shape or form, there's a performance fee. The performance fee is a flat 6% through the Access to Capital program, which we split with you 50-50 as a joint venture partner, or it's 9.5 through the Capital Ready program version 2.0, which we split 50-50. So that's about 5 points to you. So just clarifying that these innovative approaches to funding are great for the client and also great for you. Also, it's important to realize, you could say, well, why would a client want to get business credit cards through us? They could just go to Chase or Bank of America or Wells Fargo, couldn't they? Well, certainly, yeah, they could go apply, but their probability of getting approved is much less than by going through our ability to get a manual review. And then there's some lenders, I digress a bit, but there's some lenders that are not accepting applicants from the general public. The clients have to come through a technical advisor like us. We're not the only one, but like us. Okay, so great news on new sources of capital opening up. The importance of our model having existing relationships with underwriters that absolutely makes a difference. We even have a call this morning with one of the lead underwriters of one of the leading financial institutions in the country. If I told you their name, you'd instantly recognize them at 9:30 Central this morning, because that's the level of relationship that we've grown to, because we've become such a big part of their new client pool. All right, and then we talked about bridge loans. Let's talk a little bit about the joint venture white label. We beta tested this a while back and learned a few things that was working and what wasn't. So it's tweaked now and we're ready to move forward. So let's put it in perspective. Anyone and everyone, I think, should be an affiliate. It's free and easy. Earn on average around $2,000 per conversion, no selling involved, no purchase involved. It's not MLM, not network marketing, but there is override commission. So affiliates, no brainer. Not everyone should become a joint venture partner. This is a more elevated role, a more leadership role, a more involved role. There is an investment to become a joint venture partner. Now, there's benefits that justify it, but let's just go through that briefly. So in terms of being a joint venture partner, we're doing a 50-50 revenue split. So let's compare. So if you're an affiliate and you brought on a client versus a joint venture partner. So let's use the Capital Ready 2.0 as a comparison. The joint venture partner is going to get 5 points of the capital raise. Well, you know that we guarantee at least $100,000 capital raise. So 5 points off of 100,000 is $5,000 that joint venture partner can put in their QuickBooks as an accounts receivable. As an affiliate, you're going to get 1 point, 1,000. So you get 5 times as much. So with any volume at all, it makes sense to be a joint venture partner. Now, we do charge for someone to become a joint venture partner because some of the other things that we're doing for them, but I'll get to that in a moment. Going forward, our affiliates are really going to be feeding into the landing page, and that's going to drive people into the Access to Capital program with no upfront. Our joint venture partners are more focused on the Capital Ready version 2.0, whereby the deposit paid by the client is actually paid up front. And the benefit of that is that the joint venture partner is earning $1,250 day one of the client relationship versus waiting. Joint venture partners can also serve the role of the financial literacy educator, but they don't have to. So if they want to be involved with the client implementation, they can, but they don't have to be. That's a difference. Before, when we were beta testing this, we kind of forced the white label, the joint venture partners, to work with the clients, and some of them didn't want to do that. So now we've resolved that. So it's up to them. If they want to work with client implementation, they can. If they don't want to, they don't have to. But the 50-50 revenue split of the upfront and the back end remains. Thirdly, it's set up to allow for a white label. So in other words, we can create branding so the joint venture / white label partner is going out to the marketplace as their entity, not as us. So they can leverage their branding and they just simply, it's called white label. They're going out to the marketplace as them, not as us. So that is an advantage. our affiliates should not be doing that. And we kind of control that from the affiliate side with the landing pages, which are coded to us. So for example, a landing page for an affiliate has our address and our phone number on it. The resources for a joint venture partner has their information on it, not ours. I think you follow. We're setting up a complete, and this is what we were told we needed to do. We're going to set up a different support mechanism for our joint venture partners. We have almost 4,000 affiliates total now, and that's great, but that's a lot of people. So with that being said, we need to treat our joint venture partners on more of a VIP platform, better support, and of course, they would be eligible for the free face-to-face training. All right, the joint venture license fee, when we first set it up, it was $100,000, and we sold a couple of those early in, but we've decided to really strip that out and bring that down, frankly, below our cost, so we can add more joint venture partners. Because while having a bunch of affiliates is great, and that's an effective distribution model, joint venture partners typically are the high income producers. They have skin in the game, and they tend to have more of a vested interest. So we did a little bit of a test, and we've decided to continue that for a limited time, whereby someone can move into the joint venture partnership role for a one-time, not multiple time payments, but one time of $2,500. That's frankly not even enough to offset our setup cost of that joint venture relationship, but it covers part of it. So again, not here to persuade you to be a joint venture partner. Some of you are going to say, yeah, that's exactly where you want to be. Others will realize, no, it's not the right fit, and that's okay. We're here just to communicate and clarify. If you're interested in being a joint venture partner, then you would just submit an email to us to let us know that you're interested, and then we can roll that forward. All right, so let's get to your questions and comments and concerns. You're using the chat function, as I call it, it's Q&A function of Zoom, to ask the questions. All right, so Barbara asked, is there a link to get started as an affiliate? Yes, there is. On the career page of the IIMFL website, Barbara, you can go get set up as an affiliate. It's free and easy. Then once we approve you, then you'll be able to add sub-affiliates and get paid. So go to the career page on the iimfl.org website, Barbara. Thank you. All right, Robert's referring to the entrepreneur ecosystem that we talked about yesterday, and that helped explain how we work with other business-to-business professionals and organizations, so forth. Thank you, Robert, for your kind words. Dr. Austin asked, how do you transition some people who finish the 4-week program into getting their first tranche money? So if someone just comes in for just the 4-week curriculum, what they're doing is they're learning and they're putting together the package. And so we're talking about the small business certification or the entrepreneurship program. So they're not doing the access to capital. They're not doing the capital ready. They're not asking us to help them get funded. They're just asking us to train them and put their package together. So Dr. Austin, that's what we do, is we train them and we put their package together. If they would like our help funding, then they need to transition into either the Capital Ready 2.0 or the Access to Capital. That allows us to work with them on their capital raise, and that allows us to pay you, as I mentioned, 5 points of their capital raise if you're a joint venture partner. So the answer to your question, I think, Dr. Austin, is if they enroll just in the educational portion, then we would need to pivot them over into either Capital Ready 2.0, as shown here on the screen, or the no upfront cost access to capital. And then at that point, we actually work with them on the capital raise. If they're just doing the 4-week curriculum, that stops with a capital match. In other words, we give them a direction to go, but we're not actually helping them, nor are we guaranteeing them a capital raise. Okay, move to the next one. Tony asks, since the bridge loan, which we're talking about right here, is intermediate financing, does it count towards $100,000 capital raise? It does, because it's a source of capital that we're providing to them, and they're going to be charged a performance fee. And Tony, as a joint venture partner, you're going to be paid 5% of that. And so, yes, any and all types of capital count towards the guarantee, because it's capital they received and it's a performance fee they're going to pay to us. Chandra, thank you for your question. I don't exactly understand what you're asking, but if anyone that's interested in being a joint venture partner, you'll just send an email in and then we can get that set up. Thank you. Barry asked, what will be the JV email address to access the VIP service? Well, it's going to be different than that, Barry, and I appreciate you asking. For our joint venture partners, we're going to have live webinars, and it's going to be just other joint venture partners, not prospective joint venture partners, not affiliates who are valuable, but we're going to focus specifically on those that are on board as joint venture partners, and that's where we'll answer questions and support. So it's going to be a standalone set of webinars, live webinars, as well as direct access to support. So it's not so much about a different email address as it is a whole support model. So if you want to get plugged in, Barry, as a joint venture partner, we can do that and then get you plugged into the what we're calling the VIP support. Thank you for that. Kwong asked, how does he apply for the $10,000 business credit card? And so that's back up here to this new source of funding. So there's nothing different that you or your clients need to do. So this is brand new, just came out via committee approval late yesterday. And so that is yet another arrow in the quiver, another source of capital that will be pre-qualifying our clients on and directing them towards that. So we'll certainly make that available to all of our existing clients here soon. Again, it's brand new. I'm sharing it with you at 8:30 in the morning Central Time on the 21st, and it's less than 24 hours of approval, but we'll be rolling that out over the next couple of weeks. You're welcome. All right, Doug asks, can you become a joint venture partner if already a branch manager? And so we certainly can work with our branches and help them switch over to a joint venture partner if they would like. And so just contact us, Doug, if you would, through this email. Let us know what you propose and we can work it out, I'm sure. Charlotte asks, is it better to be a joint venture partner than a branch manager? They're two different roles. The branch manager is one that is deeply embedded in their community. The expectation is that they're full time, right? They're deep into it. Think about opening a State Farm office or an Edward Jones office. You don't do that part time. You're fully engaged in it. Where joint venture partners don't need to be so much. It can be very part time. Now there are expectations that our joint venture partners are generating at least 10 conversions a month. If they're not, they're kind of wasting their time and wasting ours. But with that being said, branch managers should be full-time plugged in. And that's what we've learned. People that dabble as branch managers usually don't do very well. Joint venture partners do not have that type of allocation of time expected at all. That's the biggest difference. Barbara asked, if you already enrolled in one program, can you now do this program? Well, I'm not explaining a new program. We talked about a new source of capital. We talked about how the funding markets are changing. We talked about how the bridge loans are available now, but you know, this is all part of our capital raise strategy. That's not a new program. And then Barbara, maybe you're referring to this, but yes, if you'd like to become a joint venture partner, it'd be great. And you would apply using this email. Hopefully I answered your question, Barbara. I might not have understood. Charlotte asked, and can one which? Let me read that slower. And can one which? I don't know what that means, Charlotte. I don't know. I'm sorry. Okay, Brian asks, hey, Brian, and we've got 4 or 5 clients to come to you today. Since you're one of our new financial literacy educators that's agreed to mentor clients, I text you twice. We need to get your Calendly link so we can get that set up. But we have 4 or 5 clients to get to you today, Brian. We're waiting on you. I guess we'll go back to Brian's question. What is the work that a joint venture partner is doing? Well, they're out generating leads and getting paid more for the leads that they generate. So they're not really doing anything different. However, they're able to have a 50-50 revenue split. They have the white label option. They have the higher level of support. And then, as I mentioned, Brian, they have the option to either actually work with the clients, kind of serving in that mentor role or not. Before, we were forcing them in. We had a very, very large joint venture partner, very smart, 2 gentlemen, business partners out of the Southeast United States. And it didn't work because, frankly, our expectation that they would service the clients didn't manifest. And so they brought in a bunch of clients, but they didn't service them the way that they should have been. And so then clients became dissatisfied. So now we've learned our lesson. Sure, you can be a joint venture partner, but you just need to let us know. Do you want to work with the clients or do you just want to feed them in? And it's okay if you just want to feed them in, but we need to know that to handle it differently. So the answer to your question, Brian, is it's up to the joint venture partner. They're certainly the sales engine, if you will. However, it's up to them if they want to do the implementation or not. Hopefully that answered your question, Brian. Charlotte asked another question, and it says, and can anyone which? I don't know if that's different than what you asked before, Charlotte, but I'm sorry. I'm foggy this morning. I don't know what that means. And can anyone which? Barbara says, thanks. You are welcome. Charlotte asked again. She meant to say switch. Can you switch? So I'm trying to read between the lines. Maybe you're asking if someone can switch to be a joint venture white label partner from being a branch. And the answer is yes. We just need to visit and make sure you're in good standing, and we can facilitate a switch if that's the best fit for both parties. Tony asked a good question about the CRM and joint venture partners. So here's another thing that we learned, Tony, is we're using Salesforce now as the CRM for our joint venture partners. We use what's called Keep, K-E-A-P, used to be called Infusionsoft for our in-house CRM. But for our joint venture partners, they're going to typically be using Salesforce. And that is going to be important if they're going to be involved with, that's important for the CRM. So again, what we've learned is what worked and what didn't work. And so we're approaching the CRM differently now. But yes, having a CRM as a joint venture partner is important, and we'll help them with that. Tony also asked, is the key difference between branch managers and joint venture partners? Well, I think that nothing's necessarily changed. It's just some recognition of what's working and what's not. The main difference is branch managers are full-time. Branch managers should be seeing 100 conversions a month, 100 conversions a month. And that it's just almost impossible to escape that's a full-time job, a full-time effort. Joint venture partners, not the case. They can dabble in it if they want, but there is the performance expectation of at least 10 conversions a month. So it's the level of involvement. And then also the joint venture partners can go out to the marketplace as a white label rather than as an IIMFL satellite office. No, Robert. Robert, thank you for your question. So affiliates do not need to do the background check. Affiliates do not need to be licensed. Affiliates do not need CRM access. Affiliates, it's free, easy, no strings attached, and they just feed in leads and they get paid. It's just super simple, super simple. Not so simple for the joint venture if they're going to implement, because if the joint venture partner is going to implement, then they need to be able to operate either themselves or through a team of financial literacy educators. If the joint venture partner says, no, you guys handle the implementation, we just want to go handle the business development, then it's much simpler, right? Really, at that point, it's just a private label, higher comp model of the affiliate model, if you look at it that way. Okay, so Brian, thank you for sending the Calendly link so we can get those clients going to you. And again, we need more financial literacy educators. We're growing quickly. It's a beautiful time. And so with that being said, if you're not licensed, we can help you get licensed. If you've not completed the background check, we need to complete the background check. And then just like with Brian and just like with Annette's had like 15 clients assigned to her in the past week. Several of you, others of you have received 10 or more new clients assigned to you in the past week. That's when you're writing the key person policy, that's on average, what, $500 to $1,000 of extra money in your pocket for 4 15-minute mentoring sessions. So anyone that's interested in actually working with the clients, we need to get you plugged in to the financial literacy educator track. If all you want to do is develop the leads and get paid, then at the base level, the affiliate, or the more advanced level, the joint venture is what you should be doing. Both roles are important. It's fine to do whatever you like. We're not here to push into anything. Okay, so Barbara's asking, and it's a good question, Barbara. So clients that enroll just in the 4-week curriculum, we're providing education, important financial literacy. We're also building their loan package, but we stop with a capital match. That is not the same, not the same as enrolling into the Access to Capital or the Capital Ready, where we actually are working with them on funding and guaranteeing them a $100,000 capital raise. So two very different approaches. Now, the Access to Capital and the Capital Ready package 2.0 both guarantee 100,000. They both include that initial 4-week financial literacy and loan packaging process, but we go on. We're not finished with them just by teaching them and setting up the documents. We're actually implementing and guaranteeing a capital raise. So it's important, Barbara, to know the difference between those two. Okay. I'll leave this person's name out because it was kind of a private question, but it's good. Her goal is really just to facilitate affinity relationships, and she's very good at it. She's going to be opening the doors to lots of churches and chambers, for example. So she's asking, what would be the right role? Well, you certainly don't want to be a financial literacy educator in that case, because that means you're working with the client. So let's throw that out the window. It would seem to me that you would be best suited then to be a joint venture partner, because as a joint venture partner, you're earning much more. You're able to label the white label to go out on behalf of you or your entity. And then, of course, the extra level support. Or you could just simply be an affiliate and work through the affiliate model, doing the same activities. It's just you get paid more, frankly, through the JV model. So it's really up to you. CD, I'll use your initials as an acronym, but whatever you'd like, we'll support you on. All right, Robert. Yeah, so once you get your E&O all straightened out, we'll be able to have you start mentoring clients. We need that. Charlotte has spoken to people about becoming an educator, and that's great. So what you need to do is give them the link to complete the background check. Anyone that wants to be a financial literacy educator, or educator for short, they have to start with a background check. Not everyone passes the background check. We had a distribution partner yesterday that just found out, unfortunately, he didn't pass the background check. That's important because we can't have people working one-on-one with clients that have criminal issues in their background, and that creates liability for all of us. And so the background check is step one for anyone that wants to be considered an educator. And so you can certainly take them to the career page, Charlotte, on the IIMFL website. They can learn a lot about the affiliate role and the educator role, but they have to start with the background check. Thank you, Charlotte, for asking that. Brian asked about, I'm going to rephrase this question. So the joint venture partners, Brian, they have a choice to either be involved with client implementation or not. It's up to them. That wasn't the case in the past. We kind of forced them to be working with the clients, and we learned our lesson. Not everybody's good at working with clients. So if you're a joint venture partner, we're going to say, yes, you're going to implement, or no, you're not going to implement. If yes, you're going to implement, then you will have someone, yourself or someone as a joint venture partner, doing the mentoring, that 4-week session with clients and writing the IULs. Getting to Brian's point, Brian's thinking about, wow, man, I could feed a lot of people in to become joint venture partners. That's probably true. And so by doing that, we do have a revenue share with you for everybody you refer in that becomes a joint venture partner. But equally as importantly, you're also going to get an override from all of their production. Thank you, Brian, for that question. All right, Tony asks, as a financial literacy educator, is IIMFL handing off leads to joint venture partners to serve overflow of clients? Yes, if they are set up and able to mentor, because we've already said, Tony, not all joint venture partners want to be involved with client implementation. Again, we used to require that. We learned that that didn't work, so now they can decide. So just like Brian's getting 4 or 5 clients this morning, just like Annette's got 15 or so in the past week, like a bunch of you have got, or I shouldn't say bunch, several of you have gotten 10 or more clients over the past week, joint venture partners can be getting that overflow as well. Absolutely. Brian asked, can we put ourselves through the program to get the capital to become a joint venture partner? Of course. Yeah. So our distribution partners can become clients if they would like to and raise capital and use that capital for whatever they want to use it for. Absolutely. Okay, Clarissa asked, why is the capital raised and the access to capital performance fee different? Great. So the Capital Ready program started as Capital Ready 1.0. It wasn't called 1.0, but it was the initial. And it's really where we got our start. It was flawed for several reasons, but sometimes you don't know things are flawed until you take it out to the market and realize, uh-oh, that didn't work as expected. So fast forward. So we launched Capital Ready 2.0. Capital Ready 2.0 requires the deposit, refundable deposit from the client up front. That is split 50-50 with the joint venture partners. They love it. They love it. Some of you that are on the webinar right now, some of you are closing 3, 5, 7, up to 9 of these a week. I mean, you're making great upfront money. And so 50-50 split, you're putting $1,250 in your pocket the day the client enrolls. So that is true with the Capital Ready 2.0, and then they have a 9.5% performance fee with the 50-50 split. The question from Clarissa is, well, what's the difference and why is it different on the access to capital? The access to capital offering came about based upon the request of several of our key influencers that said, hey, let's take something to the market that's a little bit more palatable to run through chambers of commerce, for example. And so it required 2 adjustments. No upfront fee. Now there's still the refundable deposit. It's just deferred until after the first capital raise. So the same deposit, $2,500, but it's not upfront like Capital Ready 2.0. It's after the first capital raise. And then secondly, they wanted a lower performance fee to be more palatable to their boards of directors. And so we brought it down from 9.5 to 6. But the bottom line is you get to choose, Clarissa, of which of those offerings you want to take to the marketplace. It affects your client and it affects how you're paid. But you could argue, well, why can't I go to a car dealership and I can buy a car for $30,000 or I can buy a car for $100,000? Why is that? Well, they're two different price points, two different value propositions. Okay, so Monique says, I'm going to have to watch this again. This is for the funding platform only. Aren't we doing this already? Yes, Monique. So, I mean, we weren't doing this before because this just launched. And this is just recognition that the marketplace is opening, but which is good, but it is requiring more of a leverage of personal relationships, which I guess that's just building our value proposition, what you and I offer clients, because we can get them funding that they couldn't get on their own. And then the bridge loans returning. So yeah, I don't know that I'm hitting you with a lot of new information as much as an update of what's going on in the marketplace. Monique. Charlotte says, great. Barbara asks, as I complete and get accepted for the affiliate, can you start the 4-week Capital Ready program or Capital Ready access? Sure. So again, yeah, you're welcome to be a distribution partner and or a client. Don't have to be either, don't have to be both, but welcome to do both. Tony's got a licensed agent on staff. Great. So we need to get that licensed agent, Tony, get that background check done. Nothing happens without that background check. So if you can, I'll email you today, Tony, the background check. We've got to get that licensed agent background check done. You and I don't want the liability of sending someone out that doesn't have a clean background to talk money to clients. And Monique, you're right. You're doing a little bit of something hybrid because of your unique background. So I wouldn't worry. What you're doing is working. Keep doing it, Monique. Robert, and this is probably the last question we'll take. So Robert says it could be confusing. Yeah, there's two different programs. There's just two different offerings. And if that's too difficult for you, then ignore one and only pay attention to the other. The Capital Ready program gets you paid up front immediately, the day of enrollment. You're putting $1,250 in your bank account today. If you do the access to capital, it's deferred until after their first capital raise. And so that's a difference. So what you got to do, Robert, is decide, what do you want to take to the marketplace? It's up to you. And then of course the performance fee on the back end varies as well. So there's two different options. I know this is probably not a good analogy, but it used to be, I guess, if you like muscle cars back in the 60s, you could go buy an Oldsmobile, a Pontiac, or a Chevrolet, and they all were essentially the same car, but they were just branded differently. And so you can go offer someone a Buick, offer someone an Oldsmobile, offer someone a Chevrolet model. If it's too complicated, then just become an expert on one of the two and ignore the rest. But we had to offer the Access to Capital program to meet the needs of some of our larger affinity partners. They wanted the ability for their members to come on with no upfront cost. Great, so we defer the deposit. They wanted a lower performance fee that was equivalent to what people are used to paying in the real estate marketplace, which is 6%. So it's really an irrelevant analogy, but it's a well-received analogy. Well, why do I have to pay 6% to work with you all to raise capital? Well, that's how we were paid. Have you ever bought or sold a house? Did you realize there's likely 6% performance fee built in at closing to the real estate transaction? That's how the real estate agents are paid, right? That's how it works. So it's a very easy way to explain away the fact that, yeah, we need to be paid for the services that we provide. All right. Well, thanks, everyone. We'll get this recording out. Let us know if you would like to become a joint venture partner. The rest of this will kind of take care of itself on its own, other than the fact you want to drive more volume in, get more clients in, because more capital is readily accessible now. And if you want to make more money for each client, then become a joint venture partner. Thanks, everyone. Talk to you tomorrow. Bye-bye.